So the biggest red flags that I see it depends on different countries. So one is that I think we're transitioning from a disinflationary period to an inflationary period. Um, and that's a view I've had for a couple of years before we started getting these rather high inflation prints. Um, and part of that has to do with the expansion of the money supply. Another part has to do with the commodity cycle that the world goes through. So we go through these periods of having commodity overabundance where they're super cheap, and then you go through other periods where because they were cheap for so long, nobody invested in them,
Right.
and then we have shortages, and then they're expensive again. And people have recency bias, so they often assume that once commodities are cheap, it's like we've solved the commodity problem. We're never going to have inflation again, and then we eventually have shortages. So one is the whole inflation dynamic, which I think is a global issue, and it won't be a straight line, but I think it's going to be a bigger issue this decade than last decade, which was very disinflationary. Another one is kind of just rising tensions, between people. Lack of trust in institutions, rising in the United States, in particular, rising wealth concentration, and just kind of like the financial system sort of not working for many people. And there's a book written a while ago, back in the 90s, called The Fourth Turning, and it kind of shows that these generations go through these cycles, and every fourth generation, usually it's like all the institutions were built like 4 generations ago, and they're kind of decaying from their own entropy. Like they're built in a different time. They're just not. They're like shadows of themselves. People lose trust in them, and you generally need to tear them down and rebuild them. But that is, of course, a very troubling time. And so that's kind of that. Like, a historian wrote that book, and it's been eerily accurate. I mean, he called things that happened over the next 25 years kind of eerily close. But a lot of that's qualitative. Whereas for me, I kind of tend to think quantitatively. And one thing I notice is that I kind of look at these long-term debt cycles where debt accumulates until it's a major problem. And all those big debt cycles occur during those fourth turnings. So that's kind of the quantitative background to that more qualitative generational cycle theory sort of thing. That's kind of the social view compared to the quantitative view. And so we're kind of going through this long-term debt cycle, fourth turning, whatever you want to call it. And so I think combined with these other factors, that's, it's not going to be easy, I don't think. I think privacy in general is also a really big theme to watch this decade. And it manifests itself in different ways. I mean, in, say, the United States, one of the issues, there's kind of corporate surveillance where everybody gathers your data. You don't even know who has it anymore. It's just everywhere. And then it gets stored in these big databases. Those inevitably get hacked by somebody.
Right.
Even ones you didn't sign up for, like the credit rating agencies, like you don't have an account there. They just gather it and then they get hacked. And then it's just out there. Even government institutions, like the federal government got hacked. It was a few years ago, and something like 20 million federal employees, contractors, all of their data was just like, I think they ended up thinking it was the Chinese that might have hacked it, but basically all that data is out there now, and that included, it was like held unencrypted. And so companies don't invest a lot in cybersecurity. They're starting to a little bit more, but it's still easier to break in than to defend it forever, right? It only takes one hack to get these big honeypots of data in many cases. And then you have in other countries, like say China, for example, then you have more of that kind of surveillance state. So it's not just corporations gathering the data; it's the government can kind of use big data, do this whole surveillance thing, kind of track everybody's spending. Big data can go around and analyze it, cause human rights issues. And so I think that from both the government standpoint and corporations is probably going to be a big theme this decade, is people wanting to retain, their own privacy, their own data, and it kind of these big questions on who can get our data, how can they get it, how can we make sure they don't just hack it and then it's out there forever. And things like central bank digital currencies, cryptocurrencies, these are whole nother vectors to manage in addition to all the things we're already managing for this whole topic. Yeah, there's a couple phases here. And so, one of the phases was that even pre-pandemic, I was analyzing that because there's so much debt in the system, that historically, when you look at these very indebted environments, so in a normal business cycle, when there's less debt, when you counter a recession, there's a deleveraging event. So basically, some companies end up losing money. They default on their bonds. Some of the debt gets wiped away, and you kind of reset. But when there's so much debt in the system, it becomes untenable for that to happen. It's like this, it would just kind of crash everything. And so when debt gets that bad, instead you have basically they print more currency to fix it. Essentially, instead of decreasing the numerator, you increase the denominator, which is currency and nominal GDP with an inflation component. And so my view is that there's so much debt in the system that whenever we had the next slowdown, we were going to have a big increase in currency. And I didn't expect the pandemic to happen, right? I mean, that was a curveball, but we got the response that I expected, which was we increased the money supply substantially. And at first you could do a lot of it because we had a very disinflationary period. People were staying home. Now there were obviously supply bottlenecks. So for example, people didn't go out to restaurants, but they went more to grocery stores. And we have like very specific supply chains around how we package foods that are not as easy to change as you think. But of course, over time, we started to adapt to that. But basically, we increased the money supply a lot. We increased demand. We held down energy usage for a while, especially jet fuel. But over time, as we open up, I think the issue is a couple factors. One is a lot of people retired early that were kind of already thinking about retiring in the next 5 years. And they just said, well, I mean, this is all happening. I'm just going to retire early. I'll cut my expenses a little bit. So that puts a lot more tightness on labor. And then two, you have a productivity increase of more people working from home, more people, finding they can get more done from home. Also, some areas where you find out that it's actually really hard to work from home, that you really need that in-person interaction, that networking. And so the market's kind of sorting that out. But I think a big thing is that as the world opens more, as we get past these waves of the virus, as it becomes more endemic, as kind of lockdowns go away, our energy usage is coming back online. But we didn't really build more capex during that process. Part of it's because oil companies, for a long time, all this past decade, especially in the U.S. shale patch, they basically would essentially light money on fire. They would drill for oil. It was not free cash flow positive at those prices, and they still got rewarded for doing it. The more that they promised growth, investors would pour money into it. But then over time, investors were tired of losing money. And then two, you had ESG concerns, right? So large pools of capital wanted to divest from the industry. So some of it was economic and some of it was environmental. And so now companies are being very disciplined with their cash flows. They're saying, okay, so we have less access to capital. We want to be free cash flow positive. We want to, only kind of drill when it's super positive, profitable to do so. And so overall, globally, have a much tighter energy situation. And so I think that's going to be a significant kind of geopolitical factor and a big contributor to inflation. And it's not going to be a straight line. Like even in the 70s, when you had that very high inflation, it was not a straight line. So in the mid 70s, you had a big oil spike, and then you had a big downward move in a lot of commodity prices. And then later it built up and you had another big spike. And so I don't think it'll be a straight line, but I think that this decade is going to be more characterized by energy shortages, more on the supply side than the demand side. But obviously that increase in the demand post pandemic is what helps kind of bring it to the forefront.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.